Welcome, everyone. Welcome to the Hurley Investments commentary for July the 1st. I am hanging out in, where am I at today? I am at Farmington, New Mexico. Spent last week down north of Fort Worth, floating down the Brazos River. Had a great 3 or 4 days with my brother. And then we also spent a celebration of life for my niece. So last week was a great week. I'm all energized and kind of have energy to come back. Excited to be back with you guys. We have Russ Kramer coming in. For those that don't know, Russ, happy birthday today. Russ has having his birthday today. And not only is Russ Kramer having his birthday today, he's choosing to spend it with us. So Russ, happy birthday today, sir. Great week. Fun to spend it down in Texas. Okay, couple quick just things to talk about. Two of you have asked me to talk about IRAs, and I have not had the opportunity to do my research. So I'm going to talk about IRA accounts next week. I'm going to go over what they are, how they work, how the government keeps track of them, why they keep such track of them, what alternatives there are to a certain degree to protect those IRAs. But the short answer is, two of you asked me to talk about IRAs, and because I was traveling last week, I have not had the time to do the research that I want to. So I will do the IRA account next week, and that'll be next week's theme is accounts that are deferred and taxes for growth that are taxed later on down the road. And I'm going to give you the risks and the rewards, obviously, with doing so. Today, we're going to talk about the tricky end of the year of our market, or another way to put it is our second half of the year. Now, historically, September is a down month, and October is the worst or second worst month in the market. And it's going to be interesting because this year is a little different. With that said, 10 years running, July has been an up month. Now, some months are not up hardly at all, but that's where we're at. When you're looking at the market big picture, and I'm going to talk market big picture for the last 2 years. Where has our gain come from in the last 2 years, or particularly the last 21 months? Where have the gains come from in the market? There we go. Perfect. Lee hit it on the head. Tech. And you could also call it the magnificent seven. And the funny thing is, or 8 or 10. And what I mean by that is 7 equaled like 70.1%. If you add 8 in there, 8 of these stocks equaled, shoot, I should have written it down. 8 equaled 73%. If you go 9 equaled 75%. And if you go to the 10th, it equals 77.3% of all the S&P 500 gains for the last 22 months. So, out of curiosity, what does that mean for the market? If you had that information and you knew that information, how would you interpret that information for our markets? Tricky question, I know, but how would you interpret it? With that said, Russ, Larry, Kohler, and Mary all wished you a happy birthday. So you've got 3 others wishing you a happy birthday as well today. Thank you for spending it with Russ. All right, I don't see anything coming up yet. How do you interpret that information? If you knew that 7 stocks were 71%, 10 equaled 77.3% of all the gains for the last 22 months, according to CNBC, and they're not wrong. I wish I could take the credit for the research, but it's not my research, it's CNBC's. So we got a lot of quiet people here today. So interesting. Mary just said, I want to be in those stocks. So if you want to be in them now, you have a problem, right? Good comment, Mary. I want to be in those stocks. So the question is, if you want to be in them now, you missed the boat. We have been in Apple. We were in Meta. We shifted out of Meta to Micron to Micron and Google L. But we have a problem. And this is the funny thing. I was just in Houston, right? Houston, we have a problem with these stocks running so well. The problem is when they beat earnings, when they beat trying to get it. When they beat earnings, top and bottom line, revenue, when their guidance is plus 10%, and I'm using Micron, right? Micron was earnings per share turned out to be 62 cents versus the 51 cents. Revenue came in at 6.81 billion versus 6.67 billion. 10% growth, and the stock fell 10%. We have a problem. And it's funny because Jim Kohler just said, and you're 100% correct, we still have a strong market. And I'm going to change strong, right? Strong means, and a better way to say it would, we still have a growing. Our market's still growing. We're still having earnings that are growing. Companies have 10% growth. They're growing. But they're not growing, and so let's put the big button there, right? But they are not growing as fast as they used to. So we talk about PE ratios. This is nothing more than a price to earnings. And I brought up NVIDIA. NVIDIA is getting kicked on a little bit. Micron's getting kicked on a little bit. The price to earnings ratio is $72.21. The forward PE is $33.33. So when your sales, and I'm going to highlight some of them, when your sales quarter over quarter are up 629%, it might justify a $72.71 price to earnings. When your future earnings next year is only at 33%, 5% of this year's earnings, are you willing to pay $34.33 for every dollar of future growth in NVIDIA? Let me say that one more time. Price per earnings, you're paying $72.71 for every dollar of growth this year. Earnings per share quarter over quarter, 629% growth. But next year at a 33.86% growth, are you willing to spend $34.33 today for every dollar of next year's growth? At 629%, an outrageous PE of $72 is heck yes, we're going to do it. At 5% of this year's growth, to spend half of that, to spend $34 roughly, does that seem overpriced to you? What do you guys think? I'm looking for some answers here. Is this making sense? At a 629% growth year over year, I'll spend $72. At a 33% growth, 33.86, 34% growth, 5% growth next year over this year's growth, I don't know if I want to spend $34.33. Is this making sense to you, or am I just talking gibberish? Can you see the correlation? People are willing to spend $72 on 629% growth. People are not willing to spend $34 on 33% growth. That is the issue we are running into with these stocks. Now, I'm going to show you a couple others just because I think it's interesting. Apple didn't have the huge run up, so it's not looking the same. Apple really wasn't considered some of the magnificent, but the P ratio is 33 at a 0.25% earnings growth. Next year is 7.7% growth, and we have a 29.83. Those numbers make sense. You know what doesn't make sense? Meta. Earnings per quarter over quarter growth, 114%. We'll pay almost $29. Next year's growth looks at a 14.66%. Are you willing to pay $22 almost? Well, Kevin, it's a 25% discount. Yes, but it's a 90% discount in next year's growth. This is why people after these runs can't wrap their head around getting into these stocks. Google, no, Amazon. That was the other one. Amazon's running. It really didn't participate last year. PE of 55. You're spending $55 for every dollar growth at a 280% quarter over quarter growth. Are you willing to spend Are you willing to spend $33.73, 60% of that on a 27.68% growth next year? You want to do earnings per share year over year? It looks worse. But you usually don't use the year over year. You're looking at the quarterly over quarterly growth. That shows how a company's growing over a quarter. People don't have the patience to look at it year over year. This is the problem we're coming up with. The driver of our stock market, the Mag 7, the Mag 8, the Mag 10, however you look at it, this is the problem we're running into. Now, most people aren't smart enough to calculate individual stocks. So they use an index. They use an index because it's general. I think that it's ridiculous. They put you in indexes that never beat the market and charge you for it. Where's the work that they're supposed to do? Where's the calculations? What are they doing for you other than sticking you in a mutual fund where they get a commission and a management fee for not having to do any work? The S&P is trading at a 21.2x next 12-month PE ratio. And the earnings I've seen, and again, it's ridiculous, it's like $275. The S&P never trades at $275. But let's do the math. This is where you're starting to see some pretty outrageous calculations. If we do 21.2 times the 279.50 actually was the number. The 279.50. So you take 279.50 times 21.2 future earnings, and that comes out to $5,925. You want to know how people are coming up with a 5,900 to a 6,000 S&P 500? This is how they're doing it. There are a couple problems though. The average trend is 19 for the PE. And rarely does the S&P have earnings over $225. When you run 19 times 225, that all of a sudden puts us back at 42.75. So as you've heard this big drop in the market, we're going to lose 35, 38, 40%. This is how they're calculating it. This is the concern on the S&P 500. This is where the market gets tricky when the market right now is trading at 54.75. So we have a couple things to consider for where our market's going to head to in the near future. Can we get to 6,000? Or are we heading back down to 4,300 with a big support level at 53.25? I think it's 20, 25. Well, why don't I just take a look, right? Since we're here, let's get the let's get our market let's get our screenshots in there. Takes a second because I've got so many here. Still bullish on the Dow Jones Industrial Average, holding the 200-day, holding the 50-day. The 50-day is crossing over the 200-day. Actually, no, it's not. The 200-day is way down there at 37,219. It's crossing over the medium pivot point. That actually doesn't mean anything. We just have an upward trending 50-day moving average. Hit 40.1 thousand and has backtracked since. Still technically bullish, definitely undecided. If we look at the S&P 500, again, got to give it a second to go through all my pictures. And actually, the level that we're worried about is right here. Matches up a lot with the 50-day, but it's 53.41, probably 53.25 on the bottom. So that's the level. If we seem to break that, we're probably looking at the 4,900 area. And then, as we all said, tech is where it's at, right? Tech has been producing a lot of the growth the last 4 years. That's why we've been tech heavy in portfolios. Give this a second for my computer to go through all my pictures. Tech has the same concern at 18,000 that if we break the 16,800-ish level, we're in trouble. We're going to take a drop down to 15,222. April lows those April lows are your Fibonacci, your Elliott waves, your most recent lows. That's the lows that people are talking about when we had that 5% pullback in April. That's where you retest at a double bottom. That's that area that you're worried about, that you're looking at. So pretty interesting. I can't believe you're going to hear me to say this, but can we get to 6,000? 6,000 is possible with, how would I say this? Let's say positive earnings from all the other S&P 500 stocks that haven't been keeping up with the Mag 10. There are a lot of stocks on the S&P 500 that can push us higher. Probably, though, the most important opportunity, and I really can't believe I'm saying this, a rate cut unleashes a worldwide easing. So one of my problems with driving all around the United States, having 1,600 miles to get from Salt Lake City down to Houston, Galveston, Texas area, I've told you there's going to be no rate cut this year. The federal government can't afford it. That's been my stance. I'm going to stay by that stance. But I'm now in belief that we will have one rate cut this year. It should be in December, but it might be in September. And here's what has caused me to change my mind or to think of the possibilities. Yes, we can't afford a rate cut, but the dollar is super strong right now. It's why gold and silver hasn't taken off. It's why oil took off, a 15% run in oil in the last week. Plain and simple, worldwide, the dollar is strong. A rate cut usually weakens the strength of the dollar. And if you look around at the world and what's happening right now, no one's really cut. China's needed to cut for a while. India would do much better if they cut. Mexico has needed a cut just to stimulate their economy. France, GDP, they have what, 115% debt to GDP. Their debt is more than all that the country brings in. Notice those places I've just talked about are all in snap elections or in elections. They're in some type of government upheaval. As I went and I kind of heard this, I did some research. No one's cutting until the U.S. cuts. The cut is the lead. I promise you, the moment the U.S. cuts, Mexico, India, China, France, you're going to see cuts in rates all the way across the board. We will see a worldwide easing, which will drive companies that do work internationally, will drive their profits higher. Yes, it'll hurt domestic companies, but maybe it won't. Maybe it won't because we put more of our manufacturing back to the United States. PCE came in weaker. The year-over-year run for 2 months on the PCE inflation numbers came in at 2.7% yearly, year-over-year inflation. One more month and the federal government in August will have 3 months in a row where inflation has slid from 4% down to 2.7%. They don't want to be behind the curve. The question is, will they cut in September and try to affect an election that they shouldn't? Or will they cut in December? Will it be a cycle? Will it be a cutting cycle as the world rebalances, being too low for too long and raising rates up too high too quickly? It really can't be a token cut. They're looking at a cycle. But a rate cut could give us another 10% and push us up to that 6,000 mark. On the downside is plain and simple. We're stretched. The numbers don't make sense for great growth numbers. They have to be perfect growth numbers. Micron got hammered. Thank goodness we had 145 numbers in place. A comment just came in, and that was breached a couple times, especially on Bloomberg. I'm curious as to why the Fed has a 2% as a target and why not 0% inflation. Technically, you need inflation. If you always had 0% inflation, your dollar value and the growth of wages is stagnant. It's a stagnant inflation. So you want a little inflation to justify a little job growth, to justify a little income growth, to justify spending. We're a consumer-based GDP. So the Fed target rate is 2%, and the neat thing is they said it's their target rate. They don't have to hit it to make a cut. They need to see it trending. But you never want zero inflation or deflation because the cycle is growth. And growth is extremely important in a consumer-driven economy. If you had disinflation, then you're not, your engine's broken. Your growth engine is broken and it's actually going the wrong direction or sliding back down the hill. Great comment. So, heads up. No trade findings and adjustments because Thursday is the 4th of July and the markets are closed. In fact, Wednesday is a half day and the markets close early. This week is really, to make it plain and simple, this week is hold your nose and wait for next week to come. It'll be low volume. All the volume's out. Wednesday, lot of Wednesday, because of the holiday, there's a lot of economic reports. It doesn't matter. There's no volume this week. It's low volume. This is the week that most people, for all intents and purposes, most people take off. It's just a low volume week. You won't see a lot of movement. It is what it is. For the United States, you just sit back and you're basically letting this week go by. You're letting this week go by, not worried about it too much. You're looking at what's going to happen next week. All right, a couple interesting articles. Retail traders came out and forced to buy the AI darling NVIDIA on the recent dip. We have another problem. I should have mentioned it up here again. It's ridiculous. Good news is bad news, and bad news is good news right now with a buying of the dips for the MAG 10 still. We're now all looking for bad news to be good news. Lower unemployment, lower inflation, which is good news, right? Lower ISM, the ISM manufacturing showed contraction. It hasn't showed expansion since February. ISM manufacturing showed contraction today, below 50. Construction spending was negative. People are kind of being idiots thinking bad news is good news to get the rate cut. It has nothing to do with that. It's inflation based. Unemployment, less construction, less new home sales, less building, not important. It's really a model of the PCE, the inflation numbers. That's what matters right now. That's the concern, and that's what people are looking at. Interesting article, though, on NVIDIA. Top Democrat fundraisers sound the alarm after Biden's debate performance. I might just recommend to you, if you've taped it and haven't watched it yet, it's not worth watching. Little bit of name calling. In all honesty, Trump was better than I've ever seen him in the name calling and childish, stupid crap he does. Biden in the first 10 minutes bumbled all over himself. It's scary. I somewhat wish we had much better candidates across the board. I don't know what Trump is thinking about by arguing over really petty stuff and not announcing his vice president. His vice president might make all the difference for those who want to vote Republican but are uncertain of Trump. So read the synopsis. Don't waste your time on the 2 hours. Amazon beefs up AI development. I just put this in here to see how some of these top 7 or 8 firms are stealing from each other. You have a big shift and people that are moving from one company to another. It's nothing more than who will pay me more to work on AI. Very interesting comments by Senator Warren. Warren's pal against weakening banking regulations. Do your job. If they weaken the regulations, you'll see banks really take off. We might need to find, instead of moving out of energy and MRO, We might want to find some banks to run into, but I don't have the confidence that we're going to see that. An interesting article on 6 phrases that say you're mentally stronger than most. It's just a good help, feel good type of article. Rags to riches. We're talking about Baidu again. Baidu has all this upside. Last year in July, it ran like 40%. Just because it did it last year does not mean it's going to do it this year. But boy, talk about a spring-loaded stock. Baidu is one of them. And here's that article on Micron stock earnings, how well they did, yet obviously they were not rewarded for their earnings. Their projections for the future, 10% doesn't cut it. The market wanted more. All right, with that said, what questions do you guys have that I can answer for you? And I'm sorry that for those of you that wanted the IRA stuff, I just haven't had the time to put it all together. So for the 2 of you that are here today to ask me to talk about IRAs, that will be coming tomorrow. That'll be coming next week, That'll be coming on Monday. All right, what questions do you guys have that I can do the best I can to answer for you? The reason, someone just asked, why do we sell MRO? And the reason we sold MRO roughly at $28.81. The target upside was $30.31, or stock ownership of ConocoPhillips at 0.255 shares per stock. We don't want ConocoPhillips ownership. They got bought out. That's going to happen here shortly. We got an upside up to the $28.81 range. We ended up selling closer to $28.51, So we're missing the upside by maybe $1.50, but it looks like it can't get above $29, and we're not looking to take ownership in ConocoPhillips. So that's why we got out of MRO. We're looking for another opportunity, but the other opportunity really has to be in a refinery oil sales side in the gasoline and what's the word I'm looking for? It has to be vertically integrated. They have to be finding the oil, they have to be pumping the oil, they have to be refining the oil, they have to be selling the oil. Why am I saying that? Because our government's giving up our reserves to artificially hold oil down. And with Trump coming on and looking good in the polls as our president, he'll open the floodgates to lower the price of oil, hopefully to refill our strategic reserves and to get our oil back down to where it was when he was in office previously. So right now, we're not looking to get an oil. We're looking to be more of an energy, at least running into the end of the year. An electric / natural gas energy play is where we'd be looking to be in. So hopefully that answers your questions on why we sold MRO and what we'd be looking to replace that with. But more so, if we're going to weaken the bank regulations, there's more of an upside opportunity in the financial market than there is in our oil market right now, or our energy markets in general. Great question. So Kevin, why did we buy NVIDIA? We bought NVIDIA recently because it was cheap with some upside potential. Yes, we've run some puts on it. The short answer is we bought NVIDIA because we rotated out of Apple, well, out of some of Apple, out of half of Apple, and we rotated out of Meta. And NVIDIA recently became cheap with its 10-for-1 split. Still being an AI, it just might take a 3 to 6 month cycle until it unleashes and goes up again. But we would not expect NVIDIA to run like it ran before. Really a target price for NVIDIA sitting at 125, 123 right now. An upside target price that's realistic is going to be in the 160 range. So that's why we bought into NVIDIA. Ma, did I answer the MRO questions for you? And Mary, did that answer the NVIDIA questions for you? Perfect. Thank you, Maud. And thank you, Mary. All right. Are there any other questions you guys have for today? Yeah, okay. So another good question. So, yes, our main goal is to protect current gains in stocks this year. But technically, we have been letting stocks run. I think only Baidu is the only stock we have protected right now. We're seriously looking at getting protection back on that we took off of Disney. Friday, we took off NVIDIA and Micron. We were expecting more of a bounce today and new money coming into the market, but it might not come till next week, it looks like, as it's a holiday. So yes, our main goal is to protect gains in stocks this year, but technicals are showing us that we still have a bullish market. So we are running a lot unprotected right now, but that doesn't mean we can't add a ton of protection on tomorrow. Does that answer your question, Larry? Perfect. Okay. Any other questions? If not, thank you for being with me today. We will not see you for trade findings and adjustments. Please enjoy a wonderful 4th of July. I will be back with you next week, and our goal is to talk about tax-deferred accounts, primarily IRAs. I want to go over the concern that some of you have at that being something the government might take from you. That's definitely overblown, but the short answer is IRAs, Roths, tax-deferred accounts are the most watched over because the IRS wants to receive your taxes on those accounts sometime in the future. So they're watched very carefully. I'll have that information for you next week. I don't see any other questions coming in. Guys, appreciate you being here. Thank you for bearing with me here in a hotel in Farmington, New Mexico. Love my time with my family here in Houston and North Dallas, Fort Worth area. It was a great time to kind of recharge the batteries, take care of my little brother, spend some time with my girls floating down a river, and I appreciate you guys giving me a week off last week. All right, I don't see anything coming in. Talk to you next week. Appreciate you being here. Look forward to seeing you next Monday. Have a wonderful holiday, and I'll see you then. Bye-bye, everyone.